Hey, it's Julie Ziemelis with Real Broker, and you are here for the 365 Hawaii Real Estate Minute. And today I am with Travis Green from VIP Mortgage, and we're going to be answering a very important question as we head into 2024. Is the market going to crash? And we're going to talk to you about that and talk to you a little bit more about why finances are going to explain why that probably is not going to happen. But we're going to let Travis give us a couple reasons why you do not think the market's going to crash.
Okay, sure. So one of the main reasons that I don't think that the market is going to crash is that, you know, if we think about 2008, 2009 and what happened there, the whole, financial landscape of our country looked different. Mm-hmm. The average credit quality of a new home buyer was much worse than it is now. Delinquencies were much higher. Bankruptcies and foreclosures were rising in 05, 06, and 07. Mm-hmm. And then we had a job loss recession that kicked off the housing crisis. And there were just a lot of types of loans that were very, kind of toxic and irresponsible.
Predatory.
Yeah. The no income, no asset verification.
No down.
Yeah, no money down, negative amortization, and, the payment option arms. And, there was just a lot of kind of like volatile, ridiculous, toxic stuff in the market. That led to where, kind of, I think, where it should have been obvious where it was going, but it wasn't at
meltdown.
Time. Yeah, disaster. Yeah. And so now, fast forward to now, we have the Dodd-Frank financial reform legislation, the creation of the CFPB.
What's that mean?
The Consumer Financial Protection Bureau.
There you go.
Yeah. But the Dodd-Frank was the big financial
reform.
Yeah, overhaul reform that came out of that. And so as a result, a lot of those, kind of loans that we were just talking about, exited the market entirely, right? And once the foreclosures and the bankruptcies and everything like that worked its way through the system, we kind of just like got all of that out. Right. So now today, most of the loans on houses today are fixed rate mortgages. Mm-hmm. The average credit quality of a mortgage borrower is outstanding. Mm-hmm. Mortgage delinquencies are at or near record lows, depending on the week. Foreclosures are very, very low right now. And then the other thing is that the total percentage of homes that don't even have a mortgage, right? So the homes that are owned free and clear is 40%. 40%. So that's up 5 or 6 percentage points, depending on the source, since about 2012, 2013. Wow. Yeah. And so that's the baby boomer generation, aging and growing their wealth and things like that. But 40% of all homes do not have a mortgage. And so that means that 60% of homes do have a mortgage. And out of those, the vast majority have a fixed rate mortgage, right? As opposed to
maybe like 3%.
Yeah, and a lot of them are interest rates below 5, below 4, below 3.
Yeah.
So the people who do have mortgages, a lot of them, maybe not people who bought or refinanced within the last 18 months, but a lot of people who have mortgages right now have a very, very manageable housing expense. Right. And in that same period of time, their incomes have, on average, increased, right? So the American homeowner is in a pretty good position overall. And so for there to be a market crash, generally you need a lot of forced sellers, meaning
they lost their jobs.
Yeah.
Their houses are unaffordable and something happens in their lives and they can no longer.
Or they're experiencing some kind of payment shock and their loan adjusts 5 percentage points higher and it becomes unaffordable. And,
that happened to us.
Yeah. So things like that, right? So a lot of those conditions just aren't in place, or there's such a big buffer of equity or free and clear ownership that it's hard to see how that could really take shape in today's housing environment.
Okay, there you go. Because we do have people who are trying to look for houses right now, and they're worried about buying at the top of the market if a crash is coming. Yes. And there's a variety of people who've been waiting, as you know, like 2 or 3 years, waiting for the crash to come. And during that time frame, housing prices have only gone up. Yeah. Right? Yes. So that waiting for the crash, because as one of my friends said, trying to claw your way back 2 years to the housing prices of 2 years ago isn't going to happen. Right. Right?
Right. Well, yeah. I mean, and so, you could say that I bought a house near the peak, right? So a house that I bought was in early 2022, but I bought a house that I could afford. Interest rates were still in the 3s at the time.
Oh, you got one of those.
Yeah. So I'm still not, me personally, I'm not trying to like flip this house or anything like that.
You just want to live in it.
Yeah, I just want to live in it, right? So even if values did dip or go down significantly for a while, like I don't consider myself affected because I have a manageable payment. I'm not that worried about it. That's only that housing prices like really crashing, I feel like is only relevant to people who are
forced to sell.
Yeah, forced to sell or trying to do like a flip, right?
Yeah.
Like if you're trying to exit pretty quickly, or if you're one of those dreamers who are like, yeah, once they fall to this level, that's when I'll strike.
Right. And you know what we're learning too about market dynamics is that we have found that all these buyers are out there trying to like get those rates, right? And all the prices were going skyrocketing because everyone had affordable housing, and people were throwing all the money at over asking, and tons of 20 people trying to, and so they're raising the rates of the house. Boom, boom, boom.
Yeah.
So affordability was being squashed because too many people are trying to get the deal, right?
Yes.
Then interest rates go up, right?
Yes.
And all of a sudden buyers leave the market.
Yes.
Right? Now housing prices are like, okay, la la la. Now, and you're going to talk to us a little bit about rates are going to go down a little bit. And now I'm getting phone calls again from buyers.
Yes.
Because people are like this, oh, now it's something I can buy. And if a bunch of buyers flood the market again, prices are going to go up.
Yeah.
Right?
Yeah. And there's the whole like lock-in effect or golden handcuffs of existing homeowners where it's like, they, like you said, a lot of buyers left the market. A lot of sellers decided not to sell too, right? Because they have a 3.25%, 3.5%, 2.5% interest rate, or they're free and clear, and they're like, I don't really want to get a 7.5% mortgage rate, right?
So they're going to stay.
They constrain the inventory, right? So the inventory is still so tight that even with rates where they've been, prices haven't meaningfully decreased, right? They've kind of plateaued. Some segments of the market have increased. I feel like here in Kona especially, if it's like what everybody's looking for and it's a well-priced home, if it's a 3-2 with an ohana especially, and it's like not terrible and priced decently, like that's going to go fast. They might get multiple offers still, and those are not cheap. So, I agree with you. Rates going down is not going to be this kind of like
woohoo, instant affordability.
Because it's going to allow more people back into the fold,
which is already too tight,
compete.
Right? We don't see a shakeout of housing anytime soon. There's not a bunch of people who are going to all of a sudden say, I'm going to just sell my house.
No.
Right?
No.
And so, we were talking about this a while ago, like about 2 years ago, that we thought, okay, a bunch of people moved here during the pandemic because they could work from home. And what we see now is that some of them are either being called back, right? Or they're like our next door neighbor was working at Yahoo and lost his job.
Yeah.
And he doesn't want to have to go back. So he's trying to find a job that now pays him what he got at Yahoo. And you can't find that job here.
Right.
And so then they're scrabbling looking for any type of like remote jobs. But I think there's still enough remote jobs out there that he probably is going to be okay.
Yeah.
But he's not going back. And I've seen 2 or 3 of my friends that said, I'll just quit my job and figure something else out instead of going back.
Yeah.
So the whole idea of like an exodus of remote workers leaving the island, I have not actually seen pan out.
I haven't seen it materialize either. Similar, I've had one springs to mind who moved here from the mainland, worked at one of the biggest tech companies in the world, longtime engineer there, and bought like a coffee farm, right? And I ran into him a year or so after they closed, and I said, "How are things going?" And he's like, company changed their remote work policy, and so I said, I'm not into that. So he got a different job, different company, same kind of thing, so that he could stay on his coffee farm.
Yeah.
Like, that he's like, that's what more important to me at this point.
Yeah.
And so
I'm telling you guys, once people find Nirvana, they don't want to leave.
Yeah. It's, not everybody, of course, but like for the people who this is their thing, like it's really their thing, and they're going to do what they got to do to make it work. And so I think that's also true with, we see some stressors. So this kind of leads into like our, where are rates heading? Yeah. What's happening now is that I think people are going to make their houses work, right? Like people pay their mortgage first, and you see credit card delinquencies going up. You see auto loan delinquencies going up. Student loan payments just kicked back in after a long time of being deferred. But again, mortgage delinquencies are still super, super low. But there are those signs of strain in the economy.
Yeah.
And so just to give everybody an idea, interest rates third week of October. So as we record this, what's today? November 30th. So on say October 20th, the average lender on a 30-year fix for a typical scenario, 20% down, great credit, was about 8%.
Was it 8?
Maybe 8.125
Okay.
for a few days there.
Yeah.
Kind of crested over 8 and then hung out around 8, but just below. Today, that same lender on average is right at about 7.125.
Oh, wow.
Right? So that's just over a month and almost a full percentage.
Wow,
point.
that's
so a huge change. And few reasons behind that. So number one is the Federal Reserve, everybody's favorite kind of like economic boogeyman, had 2 consecutive meetings where they held the Fed funds rate steady, right? So that doesn't directly impact mortgage rates, but it filters through the entire financial system. So they held rates steady. People kind of broadly believe that they're not going to raise anymore. They're not going to declare victory because they don't want the market to go crazy again, rates to plummet ahead of schedule and then undo a lot of their work. But, inflation has come down meaningfully, right? We were at 9%-ish in summer of last year. We're about 3.2% right now for the Fed's preferred inflation gauge. So that's a main reason for that. Jobs, there have been fewer job openings in the last jobs report. We've had some revisions to previous jobs report that showed fewer jobs added. More job openings and fewer new jobs and rising unemployment claims. So there are signs kind of bubbling up that the Fed's policy has done what they meant for it to do, which is to constrain inflation and to be sufficiently restrictive on the economy.
Right.
And so as a result, the bond market had its best month, depending on your measure, since like 1985 in November. And so a great month for the bond market means a good month for mortgage rates. Right? So that's why we were able to see mortgage rates start the month off near 8%, and they're ending the month near 7%. Massive amount of movement in a short period of time.
Yeah, and most people did not think that was going to happen.
No.
They thought we were going to hang on to 8 all the way through the rest of this year.
Mm-hmm. Right? Yeah. I didn't think, nothing would surprise me at this point, right? Like, I'm just not, people are like, what do you think is going to happen? I'm like, I don't know. Okay. Jerome Powell could turn into a giant talking lobster at this point, and I would just be like, okay, cool. That's season finale, I guess.
So, okay, but I am hearing that some prognosticators are predicting that we will see lower rates as we head into early summer.
Yeah, so the optimistic forecasters are now pricing in a rate cut from the Fed as soon as May of this coming year. The more pessimistic, I think, probably see a rate cut near the end of 2024.
Oh, that's sad.
Well, but almost nobody sees another rate hike. Right?
No,
so,
that's true. That's true.
It's still possible, right? The economy could, if rates go back up, it means the U.S. economy is outperforming expectations, right? So it's kind of like it's bittersweet.
Right.
If they cut in May, that means that, that's kind of like a... they're starting to hit the brakes, right? Because they see something forming that they want to head off, or maybe blunt a potential recession.
Yeah. And, obviously across the United States, people do like to buy houses in May because they're trying to get their kids involved in schools and things like that for the fall.
Yes.
So April, May is usually the top of the housing market. And so it's like, oh, yay, it's a sale on housing. Woo. But as soon as that starts to happen, then the prices start to go up and everything else, right?
Right.
So then if they see that, then by November, where they do that, okay, well, we've given you 3 months. Now we see this is too much. Then they start to crank it down again.
Possibly, but the housing market isn't the only thing at work there, right?
Yeah.
So there could be other things that knock the economy off course, or we could have some kind of job loss recession that materializes that we're not seeing right now.
Okay.
And all of those things would kind of conspire to cause the Fed to bring rates lower.
Okay. Okay, well, but how about the election? People always talk about the election year being is that real?
I don't pay much mind to it, honestly.
Okay.
I just
because the president of the United States does not influence the mortgage rates.
Right. I mean, Jerome Powell was appointed under the previous president. The current president kept him on. So they're supposed to be apolitical. I don't think there is such a being as an apolitical being, but I'm not one of those people who is convinced that whoever is in the White House at the time is like pulling the strings of like what's happening with the economy. Because people are pretty disgruntled about the economy right now, right? Like inflation's come down a lot, but that doesn't mean things have gotten cheaper. It just means they're getting expensive less slowly or less quickly.
Yeah.
But so like, I don't know, if I was in charge and I had the ability to like change things, I would.
Yeah,
right? Like,
yeah,
I would
yeah.
just be like, I would just make it less frustrating for the American consumer.
Yeah, but the thing is, now we've learned too. I think I've been around for a while, and you've been enough to see that we saw the crazy, horrible experience of what happens with monetary policy in the housing crash in
Yep.
2008.
Yep.
And then we see what happened to the United States when you give everybody free money at 2 and 3%. Then everybody's like, "Oh, woohoo, best day ever!" And all of a sudden, the headache has to show up at some place, right?
Yeah, exactly. That's a good way to say, because they talk about the Fed taking away the punch bowl, and so
Yeah,
we're in the
it's like,
hangover,
"Oh,
right?
no,
So
where's my drink?"
yeah, the party went on for a long
It
time.
went too long. is what
Everybody
happened.
over imbibed, and now everybody's got a pounding headache. But,
Right.
and hopefully it doesn't get worse than that. So the people who predicted a so-called soft landing, meaning the Fed could arrest inflation with tighter monetary policy in the form of higher rates and successfully thread that needle without causing a recession, that's seeming more plausible.
Yeah.
I wouldn't say that we're definitely in that territory yet,
Because some people do believe that we're in a recession.
some people do. I mean,
Yeah.
they're not correct, but
We're not.
well, not according to like the
Wait, it's
the
a
bodies that like
two
define it.
quarters after. So it has to be normally it's 2 quarters that have lost.
2 consecutive quarters of like negative GDP. And I mean, third quarter GDP I think was like 5.2% positive. So,
so it's
just like just gangbusters for the U.S. economy right now.
What's going on out there?
Yeah, but I mean, October, American consumers pulled back their spending in October.
Yeah.
But
then they had some crazy
But then Black Friday and
Black
Cyber Monday,
Friday.
all-time records, right?
Oh,
Up
it's-
10% from last year. And so I don't know nobody knows what's happening, right? Like I feel like the pandemic just flipped over the table and knocked all the
Everyone's
pieces
going, yeah,
off, and
I-
it's just anybody's guess at this point. It kind of
Yeah.
rewrote the whole story.
Yeah, and if they think that everyone's having a grand old Christmas with that punch bowl, we don't know what could happen when they say, "Oh, let's get through the season and see what happened." But at least though, with everybody having a grand old Christmas time, it says that people are feeling good,
Yes.
right? And you don't see crazy housing. People are not tossing their houses off the end. So if there's supposed to be a crash, it certainly isn't happening anytime in the near future.
Yeah, I mean, it's just hard to see people. Even if you think that the equity that most people have right now is like way overinflated because of the run up in prices.
Yeah.
Well, that's some segment of homeowners, right? And it's some segment of equity. But there's a ton of equity that's been built over years and years and years and years and years in different markets. Like if you own a house in say in Kona or in Seattle or anywhere like that, and you bought it in 2012, right? I mean, unless you've been taking out, home equity every year,
Your house is kind of 75%.
yeah, right, if not more, right? So housing prices could crash 25, 30%, and a lot of people would still have tons and tons and tons of equity,
there we go.
especially those people who have no mortgage, which is 40% of homes.
Right. And that's another thing too, that yes, when people were losing their homes but they had nothing in it, then it was easier also to throw the keys away and say, "I'm done," where everyone has a stake in the game now because of down payments and everything else.
Right.
So.
I think that, I know a lot of people talk about a crash or a potential crash, and I just think that like the more pressing, probably more difficult to figure out and intractable problem is just affordability, right? And it's hard to see because I don't think that there's any one kind of like silver bullet policy solution or private intervention that would meaningfully put housing affordability on a path to being fixed. And so I worry that those of us who bought, or those of you who bought while rates were super, super, super low, and own property in that kind of context, are kind of maybe permanently in a better economic situation than people who weren't able to. But I can't bring myself to believe that will be the case. But
At this moment, it is.
At this moment, it is, right? And so, so how to address that? Because obviously the high prices and the high mortgage payments are trickling down to higher rents and things like that. And we just don't have enough housing stock in general. But I don't know. The long-term affordability outlook is it's hard to see how it gets fixed.
Yeah. Well, okay. So that's some good news here. government intervention usually counts for something, even though some people don't like government intervention. However, what's happening here on the Big Island is that the government is actually going to be giving like 6 or 7 different nonprofit affordable housing developers like $70 million.
It's awesome.
And they had like 22 developers ask for the same amount of money. And so they had put like 2 years worth in the coffers, and they're going to get that $17-20 million out into the world. And then they're going to build up it again. And then there's going to be more. So at least now they're kind of getting on it.
They're going
so
for it.
They're going
doing
for
something.
It. So there's going to be different affordable housing communities. And the cool thing is that you have to prove that you are local. You have to have a job here. You have to have shown up that you actually have, that you grew up here, basically. Sure. So that way, at least the people who are on the island can actually have housing that just goes to them.
That's
and
great.
They're not competing against investors and people from off the island.
Yeah.
And so I do think that sometimes the government needs to step in and change market forces when it comes to a point where we're in a crisis.
Yeah. Well, I mean, look over on Maui right now. What they're talking about doing is paying people who have rental properties to basically, they're going to pay them to rent or to house people displaced by the wildfires. And if it was a short-term rental, there's a certain amount they're going to get. If it was a long-term rental, and these are like market rates that they're going to pay these property owners to say, look, we're spending too much money to keep these people in hotels. They need some kind of stable shelter. Here's what we're willing to do. So,
do we know if that's being taken?
I believe it's in the works right now. I think.
But I'm wondering if investors who own single family homes that they were renting out
I'm sure
term do not
that's
really
the
want
carrot.
people.
I'm sure there's a stick.
I'm sure
there's got to be a stick involved.
Oh, maybe
too.
they'll raise their rates by like, if you don't do it, then we're going to raise your property tax by like 3 times or whatever.
Because the state of Hawaii already has, or each county already has like a pretty aggressive property tax regime for primary residents, homeowners. Property taxes here are very affordable. All things considered, especially compared to other parts of the country. For second homes and vacation rentals and investment properties and things like that, those are hefty property taxes. In many cases, 2 times or more what it would be if it was a primary residence. So that is a lever they can pull. They can just say, you know what?
And there you go. There's a government working on behalf of the people, saying we'll give you the 4% resident rate versus the 11% investor rate if you will open your home to do this. Right?
Yeah.
So that's when people get clever and things can actually change.
Yeah.
Right?
Absolutely.
Yeah. So that's what we're looking for. Okay. Well, then we are going to wrap this up with Travis, and we're going to have him back again as soon as things start to change again to give you guys another update. But also he does an amazing job with our clients in helping them find mortgages and loans. And we hope that you will see that he is very knowledgeable. And he's also Johnny on the spot and getting back to us and getting our people prepared with pre-approval and strategy on getting homes and getting deals closed on time.
Absolutely.
Yep. So A1 here. Thank you very much for joining us. And you guys, if you have questions and you want him to cover other topics in the future, please drop them in the comments below. And we will see you on the next video. So don't forget to subscribe. Aloha.